Green bonds are playing an important role in corporate finance by directing funds towards projects that provide clear environmental benefits and help build long-term resilience. They have quickly become a key part of sustainable finance because they meet the growing interest from investors who want their money to support environmental, social, and governance goals, while also aligning with companies' growth plans. With climate change and sustainability becoming central concerns for businesses, companies are now under increasing pressure to integrate these goals into their financial strategies. Green bonds, which are fixed-income instruments used exclusively to finance environmentally friendly projects, offer a way to meet this challenge. They enable companies to raise capital and show their commitment to sustainability, which is important to both regulators and investors. These bonds fund projects like renewable energy, clean transportation, sustainable resource management, conservation efforts, and climate adaptation. To ensure transparency and accountability, frameworks such as the UK government Green Financing Programme require clear reporting on how funds are used and the impact they achieve. Additionally, institutional green bonds often benefit from a slight reduction in borrowing costs compared to regular debt, known as a greenium, which highlights their growing appeal in the financing market. Corporates issue green bonds for several reasons. First, they gain access to capital by tapping into a growing pool of investors focused on environmental, social, and governance criteria. This also enhances their reputation by showing a clear commitment to sustainability, which can improve brand value. Additionally, green bonds help diversify funding sources and align companies with evolving regulatory demands, aiding in risk management. Transparent reporting associated with these bonds builds confidence among shareholders, regulators, and customers. On a larger scale, institutional green bonds issued by governments or corporations generally offer interest rates similar to conventional bonds, but there is often a slight reduction known as the greenium, where issuers may pay 5 to 25 basis points less. This reflects strong demand for sustainable investments rather than a major financial discount. Funding for green bonds comes from a blend of public and private sources. Governments, like the UK, raise money through sovereign green bonds and retail green savings bonds that finance projects addressing climate change, biodiversity, and green infrastructure. Corporations and banks issue green bonds to support renewable energy, sustainable transport, and eco-friendly building projects, while financial institutions structure related green loans and sustainability-linked bonds. Ultimately, the capital comes from institutional investors such as pension funds and asset managers, as well as retail savers who buy these bonds. Their investments are guided by frameworks like the ICMA Green Bond Principles to ensure projects align with environmental goals. Since 2021, the UK government Green Financing Programme has raised over £51 billion through green gilts and retail green savings bonds, which have been crucial in funding climate change mitigation and ecosystem restoration. On the corporate side, many multinational companies in sectors like energy, transport, and finance are increasingly issuing green bonds to support renewable projects, sustainable infrastructure, and carbon-neutral initiatives. This approach offers several benefits for corporate strategy, such as aligning with ESG goals, attracting investors who want transparency and impact, enhancing long-term resilience by reducing environmental risks, and staying ahead of stricter regulatory requirements. However, some challenges remain, including the risk of greenwashing, the lack of global standardization that can discourage investors, the demand for detailed reporting on fund allocation and impact, and higher costs associated with issuing and verifying green bonds compared to conventional ones. Overall, green bonds go beyond just financing. They help companies invest sustainably while building stronger, more resilient businesses. As frameworks develop and investor interest continues to grow, green bonds will play an increasingly important role in shaping the future of corporate finance.